I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Well, let's get straight to the burning issues in private markets. Fear seems to be keeping greed in check as private equity is preferring cash to deals. Plus, developers treading water as they take out loans to avoid fire sales of their properties. And lifestyles of the rich and famous, we take a look at what superyacht sales are saying about sentiment among the world's wealthiest. Let's get into some of these burning issues. With me today, Bloomberg's Sonali Basak, Adam Temkin, and Natalie Wong. Let's start with you, Sonali. The total value of U.S. buyouts has fallen 25% through October compared to the year last year. Why are private equity firms not putting more of their cash to work?
Well, one reason you can think of is valuation. So, for example, Morgan Stanley has pinned the first half of this year as the highest valuation since 2000. And so equity valuations are high, but also leverage levels are very high. And one main way private equity firms make a return is by de-levering the companies that they invest in.
So are we expecting to see a pickup in the number of LBOs next year, or what are we waiting for here?
I think on one hand, people are waiting for valuations to come down a little bit. There's only so long you can hold on to cash, right? Everybody's looking at Warren Buffett. Everyone wants him to spend more. But with that said, until that happens and until people get comfortable with the debt markets as well, you're not going to see this come back in full swing.
But even Warren Buffett tried to bid on a deal recently and got outbid by a private equity firm, right? And he bowed out and said, listen, I don't feel comfortable with these valuations.
Apollo eventually got in there and ended up buying this company, Tech Data. And so you are seeing people dive in because you can't wait. You can't hold on to cash forever, right? But at the same time, and remember, the KKR's proposed potential rumor about Walgreens is a huge buyout. But again, still a rumor, and we'll see if these big deals start coming back.
All right, this all brings us to Adam, because one impediment standing in the way here of more leveraged buyouts has been valuations, particularly of loans, which has not been as high, and frankly, there has been weakness. What have we seen in particular with collateralized loan obligations, considering the fact they are the main buyers of the leveraged buyout debt?
CLO returns have been lackluster across the board, especially for the riskiest slice, the equity. Nomura said it's a range of -15 to 5, the lowest since 2013. Why? Widespread, less economical to put these deals together this year.
So, but even the top tier, so basically the way that this works is it's a pool of leveraged loans and it's tranched out in levels of varying risk and return. And even the top levels, which have investment grade credit ratings, have returned way less than investment grade bonds. Why has there been such lackluster demand for this vehicle?
Spreads across the board this year have been wide or stagnant, and you have fundamental problems in the underlying leveraged loans. There have been increased loan downgrades, right? We're worrying about all these triple Cs within CLOs. We've had price drops. There's a higher percentage that are trading less than $90, less than $80, or distressed loans. And you have idiosyncratic risks in some of these loans, like healthcare loans, because of regulation. All of this means weakening arbitrage, constrained arbitrage.
Just real quick here, 2020 expectations. Do people expect the market to rebound for CLOs?
Much lower. So this year, right now, we're at 110. Last year was a record of 130. Well, guess what? Next year, they're saying 80 to 90 billion, maybe 75. A bear case could be 60 billion.
60 billion of CLO issuance. Thank you so much, Adam. It all leads us to Natalie, and that is weakness that we've been seeing in the housing market as well, at least in certain pockets, particularly coastal cities. I'm wondering, from your perspective, what are we seeing out of condominium developers in particular in order to survive amid this weakness?
For condo developers in particular, especially in cities like New York, where the condo market has really taken a hit in recent years, they're starting to take out some loans, such as condo inventory loans, which are basically used to help carry the cost of unsold units in a slow market. And we're seeing them pour into this market to try to get more loans while they keep their projects afloat.
How long will it take for the glut of supply to really work its way out in order to get a more normalized level of supply versus demand of these condos?
It's really hard to tell because right now the market is already struggling amid a series of legislations, potential taxes, a slowdown in foreign buyers coming in from places like China. And at the same time, we have thousands more units coming into the market over the next few years. And we're not really seeing that shift in buyer demand right now, because a lot of times the prices are still very high, and a lot of the developers are not yet adjusting their pricing to match the market demand.
Natalie, if we didn't see this time of lending to developers in order to not sell their condominiums quickly, would we see prices plunge much more than we've seen?
It's hard to tell. I mean, in certain areas, we've already seen prices plunge. If you just look at Billionaires Row, for example, where there's a huge concentration of ultra-luxe condos, the value of contracts in that area has already dropped 90% in the second quarter compared to a year earlier. So we're already seeing some of that pricing adjustment.
Thank you so much to Natalie and all of our reporters. It brings us to the real estate roundup. My guest today, I'm so pleased to say, Jonathan Miller Samuel, President and Chief Executive Officer, who's been surveying the landscape of real estate for years and years. Jonathan, can you give us a sense of just how pronounced the weakness is that we've seen in certain coastal cities when it comes to the high end?
Well, really, we look at a market that is weakest at the top and tighter as you move lower in price. We tend in real estate to brushstroke everything's the same, but really we have a significant oversupply in the high cost, high tax markets in California, New York specifically.
What's the range here that we're talking about?
We're talking about, in terms of price range.
Price, yeah.
Yeah, price range. So the top end of the market in New York, the top 8% starts at around $5 million. And in California, it's about half that. And both markets are seeing a slowdown or a significant slowdown in activity simply because buyers are there, but sellers are anchored to pre-SALT tax conditions.
You know, let's go to what Natalie was talking about, these loans that developers are taking out in order to keep good on all of their debt. It's basically a revolving door of money here.
Very popular.
It's very popular in order to avoid having to sell their condominiums at fire sale prices. Is this going to work?
It will up to a certain point, but you can't delay the inevitable. I do think that we have still a lot of correction in front of us at the very high end of the market. We've seen, specifically in New York at the very high end, we've seen discounts averaging about 25% off of prices that were set in 2014-15. So we really had a correction at the very high end. The middle and entry level, we're not seeing that sort of discount.
How much further downside are we going to see at the high end?
I wouldn't be surprised if it's another 10%. We have a lot of things going on local to New York with the mansion tax and all kinds of anti-development sentiment within the political zeitgeist that could be a real headwind for these properties to move.
When or does it trickle down to the middle and lower end of the spectrum? Well,
I think it is almost, you could almost say it's happening now, but the sharp drop in mortgage rates over the last year, just full 1% drop, has mitigated some of that decline. I think the market today would generally be weaker overall if we didn't have the drop in rates.
Is there any place when it comes to cities that are actually seeing price increases or some kind of optimism? Because we've been talking about these weaknesses for a while now.
Sure. Really what we're seeing now is in low cost or no tax states like Texas and Florida. South Florida in particular, we're seeing activity or sales levels rise, which is in contrast to what we're seeing on the east and west coast. We're experiencing, those markets are benefiting from this migration from high cost to low cost.
I'm wondering how much this is being framed incorrectly and how much cities in the United States just generally are perhaps getting a little overbuilt given the fact that the population of the U.S. is not growing that much. I mean, how does the population factor into this?
Well, it's interesting because we've had such low cost of capital over the last 5-6 years post-financial crisis that we've been building, but what we've been building is the wrong kind of product. We've been building skewed to the luxury or high end, whether it's rental or purchase, and we haven't built the right kind of starter product. So what's happening across the U.S. is prices, just like we're seeing in New York and in California, LA in particular, we're seeing prices rise for first-time buyers, and it's reducing affordability because we're not adding to the housing stock low cost or affordable housing.
So people are going to rent forever, basically.
Well, don't say forever, but certainly the rental market is booming right now, and we're seeing real strong price growth in these cities that are having weak luxury sales activity.
And this certainly has been an area that a lot of real estate firms have been getting into, is the rental space. Thank you so much, Jonathan Miller, Miller Samuel, President and Chief Executive Officer. Coming up, this power player of this week, Hamilton Lane Vice Chairman Eric Hirsch. He tells us if he's worried about an economic downturn.
The data is starting to tell you caution, 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 caution. We're getting closer, getting closer, getting closer.
I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in private markets. To be or not to be public, that is the question, and one that Eric Hirsch, Vice Chair at Hamilton Lane, addressed when he sat down with me recently. Fewer companies choosing to IPO, and there's plenty of money on the other side in private funds, keeping them afloat. Take a listen to what Eric had to say about that and the broader private asset industry.
You're starting to see this real tension between kind of founder, entrepreneur, and investors. Not everyone's on the same page as to where they're trying to drive these businesses. What's also not clear is whether a lot of those founder entrepreneurs want to ultimately be public and deal with the regulation, deal with public shareholders. And so at some point, you've got a real problem there around how do you ultimately get out of things that are that big without going public?
So there's this idea by a Columbia professor of blitzscaling, that some of these companies that were startups got too much money too quickly. Do you agree with that kind of criticism?
You can certainly see it in a handful of examples where there was a kind of big run for we got to get market share, we have to build brand, we have to do both those things very fast. And so what you saw was a lot of capital coming in very quickly to try to go scale very quickly.
So what's the potential consequence for that?
I think you're going to see a few things. I think you can definitely see valuations for some of those unicorns and some of the tech pieces coming down. And I think you're going to have to figure out with leadership, what is the exit channel?
Where are sort of the pockets that you're finding something?
I think we're at this interesting spot where you're kind of getting back to basics. It's not trying to find cheap companies. One, if they're cheap for a reason. They're probably badly broken or not a particularly good business. I think where we're seeing the best opportunities are kind of mid-price deals that you can actually make better. And so they're good businesses, they're not great businesses, but with private equity help and influence and bringing in some of those resources, you're trying to make them into great businesses.
But given how much competition there is, aren't you concerned that the entry prices are just too high to do much with?
No. And we're not concerned about that because I think the opportunity set is growing rapidly. What's interesting is if you look at the opportunity set of how many private companies there are globally, and you measure that against how many public companies there are globally, public companies are basically flatline. You're getting 2, 3, 4% kind of growth in the number of public companies around the world, and that's 0 in the US. The private companies are still growing at a huge rate of speed. And so while there's a lot of capital and there's lots of private equity managers, the opportunity set's actually growing faster than the capital raise.
So you talk with also a lot of pensions and other investors who need to put their money and get something more for it. Are you telling them to lower their returns expectations, even if they expect private equity to outperform here?
Yeah, I think, well, one, we don't have to tell them that. They've already lowered them.
Okay.
So I think there's a recognition.
But not to maybe where they need to be.
Maybe not. I think that's, I mean, when you go around the globe, and I think sort of our vantage point of clients truly all around the world, and we work with clients ranging from enormous sovereign wealth funds down to high net worth individuals and retail investors. So we're really sort of seeing the spectrum. What's interesting to me is that there's not a uniform perspective on what can I expect, what should I expect. In general, I think you're seeing investors kind of taking return expectations coming down. The challenge is where are they moving and where are they going to? This has been the big driver of why private equity capital is rising, because they are making a conscious decision to move out of listed equities, to move out of listed credits, and they are moving to the private markets. And they're doing that because on a short-term basis, 3 years, or a long-term basis, 15 years, the private markets has been a better place to be on a net basis.
What do you think is going to be the fastest growing asset class within private markets over the next decade?
I think it's going to be credit, because I think we'll shift from performing credit to non-performing credit. So I think as the markets begin to soften here and you start to see cracks, I do think that kind of private credits are going to grow enormously. we will likely be growing more around non-performing credit.
Okay, so when is that going to happen?
Well, look, I think the signs are starting to kind of flash. I don't think they're flashing red, they're flashing orange. I think we are getting closer, closer, closer. It's hard to ever expect to see a major downturn in an election cycle. Obviously, current administration will do everything they possibly can to kind of keep the economy going. I think we sort of need to get past the election and then sort of see what happens to see whether you start to see that market begin to fall apart.
Which sectors are most vulnerable when we do get that downturn?
Well, I think, retail clearly has been a place where, depending on how tied you are to the consumer and what price point consumer you're sort of dealing with, you have seen that in downturns move pretty aggressively, pretty quickly. Who knows what kind of new regulatory environment we might be in? So will healthcare be impacted by new regulation? Will energy sectors be impacted by new regulation? Will financial services be impacted? I think that's what's sort of most in the danger spots. I think technology, particularly because most of private equity is dealing with very small technology, is probably in some of the safer places.
That was my conversation with Eric Hirsch of Hamilton Lane. Now you know how his firm is preparing for a downturn. Another major alternative asset manager, Brookfield, also spoke recently about potential distress ahead. Chief Executive Officer Bruce Flatt says the $511 billion firm is prepared.
We have more dry powder in funds, more cash on our balance sheet. Our balance sheets are more financed long-term, getting ready for the point where we can capitalize on situations if the markets turn. If they don't, we'll be fine.
So here's the big conundrum. Right now you have private equity firms around the world hoarding cash, preparing for a downturn, expecting some sort of recession or at least reduction in the asset prices. And yet that is part of what is perpetuating the credit cycle, given the fact that any dip in valuations is met with more buying. Coming up, this week's Billionaire Beat focuses on what Superyachts show about the global economy. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Time for pension pressure. Morgan Stanley Wealth Management saying investors need to downgrade their expectations for the performance of private investment funds. That's put the managers of vast pots of Californian retirement savings in a quandary. Bloomberg's John Gittleson joins us now with that story. The question really is, John, how much is this a fear of a big downturn where these assets lose everything? And how much is this just a reduction in returns expectations?
I would say it's much, much more the latter, not fear of losing everything, but pensions face a couple of dilemmas. I mean, they're afraid they're not going to be making money from fixed income and stocks. On the other hand, private equity, it's very hard when you're at any scale to put your money to work, and especially if you want to put your money to work and out-earn what you could get in stocks and bonds. The one advantage that pensions do have is patience. These are long-term investors, so they can put their money and lock it up for a long time. So they're counting on private equity to deliver that illiquidity long-term lockup premium.
Yeah, and to that point, I recently spoke with CalSTR's Chief Investment Officer, Chris Ailman, about his firm's investments in private assets. He said that he is in no rush to increase its allocation to PE. Take a listen.
We're not going to chase that 13% target. We're investors, so we want to be a steady investor over time, spread out over the vintage years as best we can.
So perhaps not adding to allocations, but not necessarily detracting from them either. Thank you so much, Bloomberg's John Gittleson. Very much a very important perspective to have on the pensions. Now for Billionaire Beat, and it seems even the super rich are feeling skittish about the future lately. That is causing some anxiety among super yacht dealers, where a good day in the office means selling a $50 million vessel. Bloomberg's Michael Sasso joining us from Atlanta for the details. So the super yacht market, how important is this? What market is this?
Well, super yachts occupy a space of about 100 feet up to 500 feet, and they start at 40 or 50 million and run up to about 500 million. And so you do have to have a little bit of money to purchase them, and it turns out that some of those people are actually feeling a little bit nervous. So just because you have money to burn doesn't mean you're so keen on burning it.
Yeah, a little money to burn. We're talking $50 million to about $600 million. You can find your range in there. But is this an important market to watch to sort of get a sense of sentiment among the ultra wealthy?
I think so. I mean, boats and yacht sales are seen as a pretty good indicator of the economy because they're, as somebody says, nobody really needs a boat unless you're a fisherman. And so they're highly discretionary. And so like RV sales and cosmetic surgery, they do tend to go up and down with the economy. And lately they have been trending down. They should be down about 20 to 25% this year. And that has people a little bit skittish about the state of the economy.
All right, why? I mean, is this because basically people don't have quite as much cash, maybe $600 million rather than $660 million? So they don't want to spend the $60 million on a yacht?
Well, it could be a lot of things. What I'm hearing from dealers is just nervousness about all the turmoil that's going on in the economy. I mean, you have Brexit in Britain. Of course, you have the trade war with China, between the U.S. and China. You have Hong Kong unrest. And what I'm just hearing is people are a little bit nervous about deploying all that money. And so you not only have the upfront cost of 50, 60, 100, $200 million, but then you have the cost of operating these things. I'm told that a super yacht of 180 feet, which I boarded in Fort Lauderdale recently, it can cost $3 million a year just to operate that yacht. That's not including the cost of 12 or 13 crew members. It might cost $50,000 a month to dock it at a port or something. So these are very expensive, and it is a confidence play, as one dealer told me.
Yeah, it definitely is a money sink. Anyone who's ever had any experience with a boat would know that. But this also might have something to do with the weather, correct?
Yeah, I mean, probably more so on the lower end. At the same time, there's some softness in the kind of middle market boat segment, meaning fishing boats and such. That has seen a deterioration of about 6%. Fishing boats are down about 6% this year. And now on the positive spin, some dealers are saying, well, it may just been some bad weather in the Midwestern U.S.
Yeah.
But no one can say it's not the sign of a deterioration.
Bloomberg's Michael Sasso, who knows more than probably he bargained on the yacht business, the super yacht business. Speaking of big money, it's time now for this week's big number. It is $17.1 billion. That is the amount of onshore bond defaults in China. At least 15 defaults since the start of November have pushed this year's total to within reach of the annual record set last year. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York. This is Bloomberg Money Undercover.